My mission is simple, to make you money. I'm here to level the playing field for all investors. There's always a bull market somewhere, and I promise to help you find it. Mad Money starts now. Cramer. Welcome to Mad Money. Welcome to Harvard Business School. Other people make friends. I'm just trying to make you a little bit of money. My job not just to entertain, but to educate you, teach you. So call me at 1-800-743-CNBC or tweet me at Jim Cramer. I know, I'm not where you were expecting me to be back at my old stomping grounds tonight. I'm at Harvard. But sometimes you get one of these opportunities, a chance to return to your alma mater, this time to interview one of the greatest executives of our time. The legendary Larry Culp, the architect of the resurrection of General Electric, and now the chairman and CEO of GE Aerospace. You got to do it. We arrive here on a day full of cross currents. A big win for a slate of Democrats last night. Big bounce after a disappointing session yesterday. Dow gaining 223 points. S&P jumping 0.37%. NASDAQ pole vaulting 0.65%. Kind of a classic rebound. A reminder once again that we all too often celebrate those who got it right for a day, betting against tremendous companies, instead of celebrating those who got it right by owning and hitching their star to long-term winners and making big money through the power of compounding. You know what? That's what this show is really about. Come to think of it, that's what my career is about. Trying to change people's lives by helping them try to make money without taking on too much risk. I say it's about how to make money in any market in my book. But what I mean is that you can make money in any market provided you realize that disciplined growth investing is the way to go. You just need to practice it unemotionally, consistently, endlessly, and implacably with persistence. Now, I learned those values here at Harvard, across the Charles River at college and the law school. When we started Mad Money way back in 2005, we wanted to do a college tour. I dutifully asked Harvard College and was summarily rejected, as we were from dozens of schools. The law school knew how to handle alumni, though, and after a nice contribution, we got the use of a hall there. You know what? This is different. This time I didn't have to invite myself. This time we were invited by GE Aerospace CEO Larry Culp, a former lecturer here, to give a talk. And yes, put on the show. And you know, how could I say no to that? With this CEO, with these kids? As I roamed the campus earlier today, I bumped into a terrific student anxious to attend our show. He said he was so thrilled to meet me because I'd made it acceptable for people to own individual stocks again. Of course, that's giving me way too much credit. I have no illusions. Many forces conspired to make stock picking acceptable once again. I was a good conduit to them. Hence, what I call the Meet the Millionaire CNBC Investing Club show we did with Jensen Huang, who runs a nearly $5 trillion company, NVIDIA, that more individuals seem to have bought than hedge funds. I celebrate Jensen, but more importantly, I celebrate those intrepid souls who stuck with NVIDIA, despite the fear-mongering money managers who spent the better part of a decade doubting what Jensen's created. Which brings me back to the vicissitudes of this market and what it takes to be a good investor. First, you have to be willing to trust the market. Sure, you wake up yesterday and you hear about how a great bellwether like Palantir was down a lot after a terrific quarter. Suddenly you're paralyzed. The stock of Palantir, which you may have thought was Palantir 2 months ago, seizes the mental wheel and drives us right into Soldiers Field, where we're rapidly enveloped by nothing but bears, and for once they have a good record. They're swarming everywhere, mauling us like crazy. We hear from money managers who invested wisely in the past saying that Palantir is the next big short. We cobble together some quotes from banking CEOs, talk about how richly valued the stock market is, even as they love their own stocks. Next thing you know, it feels like we're at a top, and the whole industry screaming at you to get out now. When you pit trust the market against get out now, buy, sell, sell, sell. Well, guess what wins? The fear factor always does. The dripping red futures, red because of Palantir's failed to rally after, it takes on a life of its own. What's the best course of action when you have days like yesterday? Let me tell you what I like to do. The first thing I do is I try to find a stock I like. Perhaps one that just reported, maybe one that reported an amazing quarter, but saw its share price obliterated because of Palantir. How about a stock like Shopify? Why pick this one? This internet behind-the-scenes player? Because I've done the homework, that's why. More specifically, I was able to get into this market's kitchen and see how the sausage was made, and I didn't like it. Shopify is a big company, and its stock, like so many others, trades with the futures, even though it's Canadian. That's why the stock started going down hard. It was just right in line with Palantir, as if there was something truly wrong with this company, the cash flow, the sales, the earnings, the outlook. These are the kinds of things that I'm asking the company's president, Harley Finkelstein, while he's on Squawk on the Street. I'm interviewing why the stock's in free fall. I recall 6 months ago the exact same objections, the exact same pack of lies. I said, don't believe him. It's at $100. Stock's up 60 since then. It was a bogus rap then, bogus rap now. Harley's expecting a very strong holiday season, despite what you might have read in any press story. See, it was time to buy Shopify, not sell it. Or how about a stock like McDonald's? Headlines come out this morning. They say it's a big disappointment, a huge disappointment. It was a big miss on revenues, big miss on earnings. Red ink, well, it made it look like the stock had to go lower, right? But what if the red ink is wrong? What if it was just one more trick of the index sellers? All restaurants have been challenged during this period. What matters is how they respond to the darn challenge. McDonald's, unlike so many other chains that lack the scale and the strength, is lowering prices, lowering them dramatically, and it's working. The other guys keep hoping customers will just get wealthier, come back. They don't want to admit that they're taking prices way too high, to levels where the consumer's too cash-strapped to afford them because they didn't want to miss their quarter. And they're missing their quarters big now. That's what we were looking at. I said before the market opened, you got to buy McDonald's because it understands what our customers in our country and the world are going through right now. There's been too much inflation. So what they did, they cut prices. That's what they did. And even though the market was bad, this stock finished up big. Why? Because the next quarter's got the $5 sausage, egg, and cheese, McMuffin, coffee, and a tater. That's like the old days, $5. That's what matters. So the bottom line, I trust the market. If you trust the market, if you don't believe that one stock controls the entire tape, if you don't take counsel of your fears and you do take counsel of your opportunities, a day like yesterday can be the way you finally get a chance to start wading in. Not all at once, that's for fools, but gradually. As we saw today, yesterday was a good time to start buying. And even if you missed it, I hope you'll keep this experience in mind the next time the averages get hammered. Let's take some questions from Harvard Business School. Hi.
Hi, Jim. Kaylee from Illinois here. Thanks so much for being here.
Thank you for having me, Kaylee. Appreciate it.
My question is this. With so much of our economic growth and market value concentrated in these big AI and semiconductor stocks, are we essentially unhedged as an economy? What happens if adoption and monetization don't pan out? And are these stocks at this point just momentum plays since valuations have gotten so high?
Okay, well, let's take a look at that. I mean, if they're momentum plays, then why can Meta be at 26 times earnings? Why can Google be at 18 times earnings when we back out the cash? Why can NVIDIA turn out to be around probably 24 times earnings if you look at the future projections? These are stocks that are all below the market multiple, so I don't think that they're that expensive. Even Amazon's multiples come down a lot, and Apple, I think, is going to have a great quarter, so I think that their PE is probably going to be roughly just a little bit above the market multiple. All these companies are actually very big conglomerates, and I know we speak to GE, that's a broken-up conglomerate, but I like the companies for what they have, which is different businesses that are firing on all cylinders. Do I think that the data center is a problem? I think that OpenAI has spent more money than it has. Until they started spending, I was not crazy. I really like the group. The OpenAI spend is a little too high. But in the end, these are the best companies in the world. They're nation states with good balance sheets. They're not momentum plays. And momentum plays are the companies that you see, I call them Sherwood Forest. The Robinhood plays that are over and over bought again. It's the quantum plays that are the problem. It's the nuclear plays that's the problem. It's the derivative data center plays that's the problem. That's where I worry about. That's what people aren't talking about. That and all the nonsense ETFs that have been put together to play momentum, that's what has to go away. I'd rather be on DraftKings and take a 14 parlay to see 5 tight ends that score touchdowns this weekend. Thank you. Yes.
Hi, Jim. Julian from New York. Thanks for joining us. My question for you is, with M&A markets heating up, what are your top picks in healthcare? Are you more excited about the pharmaceutical companies that will be buyers in this market or the biotech companies that will be sellers?
Well, it's a great question. I mean, look, I think Amgen needs to do something because they've got to broaden the portfolio, where they need to be able to tell a little bit better story about some of the things that they have. A lot of good medicines, and they had a really good quarter last night. Look, my Chapel Trust owns Bristol. Looks like a mistake because I believed in Cobenfy, which is a pretty good product, but it's not selling well at all. 104 million in scripts last quarter. I do believe that there are very few biotechs that I really want to buy right now because they're so picked over. Look, in the end, there's Eli Lilly and there's everybody else. Thank you. Remember, if you trust the market and you take counsel of your opportunities, a day like yesterday, pretty good buying opportunity. On Mad Money tonight, there have been a few greater corporate breakup stories than GE. I'm sitting down with the bankable CEO of GE itself, Larry Culp, here at his former stomping grounds at Harvard. Find out how he's managed to steer the ship so successfully. Then one of the biggest semiconductor deals was just announced, sending both stocks soaring. I'm finding out about the deal with the CEO of Skyworks Solutions. And Axon fell majorly after earnings. But were the results really worthy of this sell-off? I'm sorting it all out with the company's top brass for a company that I have championed for many years. So stay with Cramer. Very good.
Don't miss a second of Mad Money. Follow @Jim Cramer on X. Have a question? Tweet Cramer. #MadMentions. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.